So what a lot of people don't know is when you buy a home, especially if it's like a new build, or I had an instance where the property was just being taxed on land. So literally the property taxes on this were showing as $100 a year. And it's basically they were evaluating it off of land. And so what happens in like a scenario like that is the lender will actually have to take 1% of the purchase price, which here in Arizona is a lot higher than the actual taxes of properties, and use that as an estimated tax payment. Now, when you have a mortgage, what happens with your taxes and your homeowner's insurance is they take those annual figures, they divide it by 12, and they tack that into your monthly payments. So like in an example, if you have a $300,000 home, okay, let's just use a new build because that's more common. You're gonna get your homeowner's insurance, which you'll probably get a really good homeowner's insurance quote for the first year, and it'll probably be, say, $600 a year for your homeowner's insurance. And then the taxes, they don't really know because they've been taxing it off the land. So they're going to use a conservative number of about 1% on the taxes. So in this case, they're going to take a tax of $3,000 a year, and they're going to qualify you based off of that. And what they do with this money is they take these totals and they divide it by 12 and they add it into your payment. So in this instance, if you take, this 3,000 and you take the 600, that's essentially going to be $50 a month for your $50 a month for your homeowner's insurance, and for the taxes, it's going to be $250 a month. So one thing that I'll do is this is overpaying for the taxes. So what you're going to see is you're going to have your principal and interest payment for the $300,000, and they're adding $300 onto your payment. One thing that we can do as a lender, at least my company, we can do it, is we will not include your escrows into your payment. So we'll take this, we could take one or two, we could take it out. We're still going to qualify you based off this, but what this is going to allow us to do is instead of adding $250 of excessive amounts onto your payments, you can pay that separately on your own and not include it in your escrow. So when you take your payment, in this example, let's say it's like your payment's $2,100, or let's say it's like $1,800 for your principal and interest, okay, on the loan. You're going to add your $50. So your total payment in this scenario is going to be somewhere around, $1,850 instead of adding another $250 on there and making this a $2,100 payment. And so what that's going to do is when your tax bill comes due here in Arizona every 6 months, you are going to be obligated to pay that monthly tax bill on whatever it is. So if the land bill is, in this case, let's say it's like $500, instead of spending $3,000 into your escrow account, you can just save up the $500 on your own and have a much smaller monthly payment and avoid having to pay more than you really need to in a scenario where they don't really have an accurate figure of what the taxes are.